is on.
Introducing
Pretty Girls Love Real Estate. Stories of everyday women breaking barriers and building wealth through real estate.
Let's get it.
Boss. BOSS.
Hello, hello. Thank you for tuning in to another episode of the Pretty Girls Love Real Estate podcast. I'm your host, Jessica Washington, and I got another amazing conversation for you all. I have Miss Jan Wabs. She is a partner with Paper Profits, which is an organization that invests in performing and distressed mortgage notes. I'm really excited about this conversation because I've got a lot of people that are interested in this topic. And I feel like a lot more people that don't really understand what that means. So she's here to kind of explain to us all what is going on in that industry and, the success she's had. So Miss Jane, thank you for joining me on the show here. Appreciate you. How are you?
Good. Thank you, Jessica, for having me.
Of course. So we're going to get all into note investing, but first and foremost, like, how did you first get started and you wanting to do anything in real estate in general?
Yeah, so more than 10 years ago, actually, I owned a CPA firm. So that's my professional background. How did I get into real estate was we had a couple clients that were real estate brokers. So my partner and at the time at the CPA firm and I, so they brought a project to us. It was a 36 unit rental project. It was an off-market deal because they were the exclusive brokers, and so they wanted to partner with us to take on that project. And I liked it because as a CPA, we want to see what's the potential on the project. And this particular project had a lot of potentials because it was the rent was under market. It was not is not well maintained, and also it was a 36 unit, it has a whole deed, right? So it's not by each unit. So we figure if we can separate them up, and then that would give us a great up on the price. So in the end, we took this project, we bought this project. From this thing, I learned quite a lot. First of all, four women, right? We were not able to purchase the whole thing on our own. So we had to get bank financing. And also, we didn't even have enough for the down payment. So we also had to bring investors in. So I learned how to raise capital. But for our real estate investors, for our audience, one thing you can learn from this thing is that to try to build a very good relationship with your CPAs, because they have the money source, right? They can, and then a lot of the CPAs also are passively invested in real estate. So that's those are the things, that's how I got started. And of course, later on, I got into note investing, but that's, next story.
Okay. Yeah, that's actually good information because, CPAs, they're around a lot of businesses. They're around a lot of high net worth individuals. So obviously they got the connections to the people with money when you're looking to raise capital. So that's a great little nugget. So right. Another thing I would say is that I've learned a lot of CPAs and people that have an accounting background in general. It's a great transferable skill to real estate because you're used to crunching numbers all the time. So I guess how is like your background being a CPA, how has that kind of helped you in your career?
So first of all, as you said, we like numbers, CPAs like numbers, and then our advantage is that we're very good at data analysis. Hopefully we are. Yeah, and then also present the numbers. Those are very good skills to have in our real estate business. right? When you look at a project, it's not just pretty houses, right? You need to get down to the numbers. Is that something will make you profit? So yeah, so definitely the data analysis and then data presentation, because when you get into the part that you want to raise capital for your real estate project, you need to be able to show your investors how this project is a great project, and you will be able to bring them profit, right? So that helps a lot. Yeah, I mean, as investors, they look at the numbers and they look at what the profit they may be able to make from the project. It's not just pretty houses.
Absolutely.
Yeah.
And plus there's a lot of tax benefits, obviously, to invest in real estate that, someone just getting started may not fully take advantage of. So that also having a CPA background or a CPA that's on your team is really helpful.
Yeah. I would say definitely you need to, even if you are not, good at taxes, and most people are not, because it's a very complex world. So it do definitely have a good CPA on your team, not necessarily to be your employee or your partner, but just to be able to advise you before you even get into a project, how you may be able to take advantage some of the tax benefits.
Absolutely. So now something a little less known is the world of mortgage note investing. So can you just talk about what that means for someone out there that might be hearing about this for the first time? And also, what are some of the, I guess, differences and similarities between investing directly in the debt versus investing in the actual property?
Yeah, sure. So, first of all, note and mortgage, I tell you a little bit about what the definitions are. They're very simple if you think about it. So when we go buy a house, you get a loan. If you need a loan from the bank, you normally will sign two pieces of paper, and one is the note, the other is the mortgage. So the note basically is a promise to pay. You promise the bank you will make a payment, and now of course it has the terms on it, like how many months is the term, and what's the interest rate, what is your monthly payments, and so on and so forth. That's the note. And the mortgage is the lien on the real estate. So the mortgage is recorded with the county, and the note is not recorded. So when we say you invest in mortgage notes, that means you purchase the mortgage and notes from the bank. You become the bank. A lot of the vast majority of the note investors, they purchase the loans from, we call it secondary market. So we don't originate the mortgage loans. We instead purchase them from the secondary market. So we become the note and mortgage holders and investors. So that's how, in a nutshell, that's how it works. We normally purchase whether they are, we call it non-performing loans or performing loans. So the non-performing loans, meaning the borrowers are not paying. They haven't paid for more than 120 days. They could have, some of the borrowers haven't paid for years, right? So those are the loans we purchase called the non-performing loans. You also can buy something called the performing loans or re-performing loans, mostly re-performing loans, meaning the loans had some issues in the past, had lapse, the borrower didn't pay, but the borrowers are paying now. So no matter performing loans or non-performing loans we always purchase them at a discount. That's how we can get better return on the loans. The pros or similarities, between the real, the physical real estate and the paper real estate notes and mortgages, both involve real estate, right? The difference is that a note investor, you don't own the real estate. the real estate is just the collateral on the note and mortgage. So it's good and bad. The good thing is you kind of have the real estate, but you don't have the hassles, right? So if the roof leaks, if the toilet doesn't work, if there's a flood on the property, that's not my problem. I'm just the bank. I'm just the note holder, right? It's the homeowner's problem. They have to fix those real estate related problems. That's the good part about the note investing, is you can always go back to the real estate if the borrower doesn't pay, right? You can always foreclose on the house, but you don't really own it until that point. So the bad part, of course, the borrowers could default on the loan, right? If you are just a real estate owner, holder or owner, you don't have that problem. There is no borrower. You are the borrower and you are the owner, right? So you don't have situations the borrowers get sick, lose jobs, or so on and so forth. They may default on the loan, and then we may have to go back to the real estate. So that's I would say, the kind of pros and cons for being a note investor. Most people like to say, well, the advantage about note investing is you kind of have the best part of both worlds, and you have, you can make a good profit on the real estate, yet you don't have the real estate problems. That's just, as a note investor, that's what we think we are, right?
Yeah.
But of course, as I said, you also have the issues like with the borrowers. So that would be our disadvantage.
Well, yeah, it sounds like the pros outweigh the cons, because if you're buying the note already at a discount and the property itself, most of the time, let's say real estate is appreciating. So even if they do stop paying and you have to foreclose, you got everything at a discount, and then the asset itself is appreciating. It's just a matter of, whether you want to deal with the operations of the property or, getting things fixed, whatever the case may be. But you can get, you're already getting the asset, the note at a discount, and then you're getting the actual real estate at a discount. So,
right. So keep in mind, though, the advantage of the possibility of us taking over the real estate is very small, right? So we normally, 90% of the time, we don't really enjoy the appreciation of the real estate. But as a real estate holder or owner, you can enjoy that part of the business.
right.
Yeah. So the other thing is, I call it the no investing business is a little bit more abstract, right? So, as a real estate investor, you see the house, you remodel the house, or you do everything with the house, and it looks really pretty, and you may appreciate that part. As a note investor, it's a little bit more boring, because all what we see is a piece of paper, right? It's the contract we have with the borrowers. So it's a little bit more abstract. You don't get to enjoy the beauty of the architect, I would say.
So you purchase a note that's not performing at the time. Obviously, someone hasn't been paying at least 120 days. How do you get them to turn around and start paying you?
So with the non-performing notes, our goal is to get the borrower to pay again. That's always our goal. Our goal, no investors, most likely they don't want to own the real estate, right? They still want to keep being the bank, being the lender, and to collect the payments. So we do a few things to try to get the borrowers to the table to negotiate with us. Because what we can do is we always try to make the payments affordable for the borrowers. The borrowers, they are normally in the situation they haven't paid for a long time, and then there's a big back payment. They can't afford to make that chunk of money all at once. They probably lost jobs before, but a lot of times, this by the time we buy them, it's already a couple years, at least a couple years later. Their financial situation have already changed. They lost job and they find another job, and they were sick and they are well now, and they got divorced and that's been settled, so on and so forth. Their financial condition has changed. They can afford to make another monthly payment again, but they don't have the savings or the money to make all the back payments it has accumulated. So the most important thing is to get them to the table to discuss with us. So we use loan servicers, and we use our legal team to call them, contact them, write to them to let them know that we will be happy to assist them. We have something called a financial assistance application. So they fill out the form, tell us their current financial situation, and then we come up with what we call options, right? Whether they want to take a discounted payoff or whether they wanted to take 1, 2, 3 options, right? We gave to them based on their financial situation, how much down payment they can make, and what kind of monthly payment they can make. And so once we send them the options, most of the time, we have vast majority of the borrowers, they would pick one of the options and then modify the loan. So that's the big part of our work.
How do you navigate around property taxes? Because, more than likely, if they're not paying their mortgage, a lot of people roll their taxes in escrow into their mortgage. So obviously that's in the first lien position. That's completely outside of the debt holder's control, what the county or the city, whatever the state that they live in. How do you navigate that to make sure, they don't foreclose on the property themselves before you get a chance to even let them, perform again?
Yeah, that's actually in our due diligence process. We have to see, first of all, we have to see if the property tax lien was sold. If the lien was already sold, we normally don't touch that kind of properties. But if the liens, if they just haven't paid for a couple years or on the property tax, sometimes we would advance
Right.
the payments to the county, so that keep us not being foreclosed on.
Right.
So yes, so the most of the time, if the lien's not sold and we purchase the lien, and then we would if the property tax were not paid, we would advance it, or we would reach out to the borrower and see if they wanted to get that current before we come up with a loan modification plan.
Got it. Okay. So I know you all invest all over the country, so there's going to be different price points as far as the notes that you're buying, but what's the typical, I guess, percentage you want to get as a discount off of, the full amount that's due?
Yeah, so it's very this is a hard question. And so we have different states, and then different states, some of them we call judicial state, some we call non-judicial state. That's from the foreclosure standpoint, whether it goes through the court or not. The non-judicial states are much faster than the judicial states. And then certain judicial states can take a long time, like New York. And some judicial states are, I would say, easier to work with, like Florida is a little bit easier. So we have to evaluate every state differently. With the non-judicial state, because the foreclosure process is so much faster, we would have to pay more. And for the judicial states, we pay less. So in the past, I would say like a couple years ago, for the judicial stay, we could buy them at about, for non-performing loans, we buy them probably about 50 cents on the dollar.
Wow.
Yeah, but now the market is different. That's actually not possible anymore. The recent one I saw for a pool of loans that was purchased was at 69 cents on the dollar. So
Okay.
that's quite a lot higher than the past.
All right. So on the flip side, once you get something like this performing again, what's the average kind of returns that you usually expect?
So the for non-performing loans, we're still talking about, right?
Correct.
So in the past, again, our target is always double the return, double the money.
Okay.
So for, if we purchase for 100,000, we expect to be 200,000 by the time we sell the loan as a performing loan. So we would double the money. But as I told you about the current condition is if you buy the loans at 69 cents on the dollar and you sell the loan at, let's say, 80 cents on the dollar when they're performing, the margin is much, much smaller. So the market condition definitely has changed, and it will continue to change. So a lot of people are asking, well, with the current banking crisis and things going on, will we see more default loans? We expect to see more and at a better price, but that's just, we don't have a crystal ball, so we don't really know how the market is going to go.
Right. And what you just said made me think of like three more questions. One of
Sure.
which I really love the concept of notes because it seems like there's multiple exit strategies. Like, you don't have to just get someone to perform and then, just slowly collect a check every month. You could get it performing and now it's more valuable, sell the note to somebody else, like you just said. Or I think you can sell part of the payments to someone else and still collect some. You can do a lot of different things. And then what's the rationale between mixing a portfolio of like non-performing notes and then ones that you buy that are already performing when you purchase them?
So there are two, I would say with us, because we have two note funds and we have two different kinds of investors. Some are more conservative and some are a little bit more aggressive. So with the more aggressive investors, they want to invest in the non-performing note. With the conservative investors, especially with their IRA funds, they would prefer to be in the performing note fund because the non-performing notes, they're unpredictable.
Right.
Right. So, and then also we have a sourcing constraint too, because if we can buy, with the non-performing notes, our goal is buy them, turn them into performing, or collect them at the discount, and then we sell them. And that's when we generate all the profit at that point. And with the performing notes, we buy them, we hold them, we collect the interest, and plus we continue to receive the discounts from, we call it discount income, because we purchase them at the discount, right? So the discount income is amortized throughout the years. So with the conservative investors, they like to see the continuous cash flow stream, right? Which they do because they're performing and then we get paid every month. With the non-performing notes, you don't see that, right? It's lumps. The profit comes in chunks, and you get them performing, you sell them, and you collect the profit, and then you go buy more. With the principal comes back. The profit you probably split with the investors, but with the principal comes back, you have to go buy more. You have to deploy the funds again. However, if the market doesn't have the inventory to supply our funds, then the money's sitting and it's not generating profit. So there are two mentality or two methods of investments going on there.
Perfect. Got it. So the sources that you're getting these notes from, I'm imagining there can be, your large banks of the world. And I imagine they're not selling, one off. They want to sell like a whole tranche of notes at the same time. So how, other than someone kind of going through you, a company like you, which you buy a large quantity, how would just your average Joe have access to buy notes, maybe, on a small quantity?
So there are some exchanges, websites you can buy. One of them is called the Paper Stack, stac.com. So on Paper Stack, the investors, just like you and me, if I have a loan I wanted to sell, I can put it on the website for sale, and then another individual investors could, they could come and buy that loan we have for sale. So it's, if you just start out, and that's a good place to go. They have hundreds of loans listed for sale. It's like you go buy a house, it's the same process, right? They'll provide you all the due diligence documents, and you review them and you bid on it, and then hopefully you can close the deal. So that's some of the exchange you can go to. There are other ones. This one is probably the most popular one, the paperstack.com. And what's your other question? I'm sorry.
Oh, just what's some sources that your smaller investor can buy individual notes?
So normally, like investors like us, as you said, we buy in pools, and they are normally sold. Some of the large hedge funds, they sell loans in pools. Most people don't, even with us, we don't purchase directly from the banks, just because the the capital is large, right? The banks they have for sale normally is 100 million, 200 million at a time, and funds like us, we don't have that much money to deploy. So although we could buy a few $1 million at a time, but that's not, that's just not enough for the banks. So the banks normally sell them to hedge funds, and the hedge funds would break them apart into groups and have them for sale. But for individual investors, first of all, is networking. If I have a loan for sale, I'll talk to some of the people like on my buyers list, and I just send it to them, and normally they just get sold that way. And so go to like note conferences, go to some of the network groups, build your own network and buy from people you know. I think that's the best way to go about. And the other thing is, like I said, you can always buy online directly.
Okay, well, you teed up another question that I had coming.
Sure.
What are some of the, I guess, are there, conferences that are popular nationwide, or are there also any trade organizations specifically tied to note investing?
Yeah, so there are lots of note conferences. The most popular ones are like one is called the DME, Diversified Mortgage Expo. And then there's also something called IMN. IMN is more expensive. DME is much cheaper. And there's also called the Paper Source. That's another one in Vegas. They normally do it. IMN, you have to be more careful because this is a big organization. They have all kinds of real estate conferences. If you just wanted to go to the note conferences, they normally have two big ones. One they do it in Florida, the other one they do it in California. So it depends on which one is closer to you. And Paper Source, Noteworthy, that's another one. DME, those are very popular ones to go to.
Okay, that's a great information right there. I feel like
Yeah.
a lot of people are not familiar with this industry, so that's good information.
Yeah, so we do have a small group. It's called the Women in Notes. We do a meeting once a month. So if any of the women that are very interested in investing in nodes and want to be part of the group, just send me an email, give me a call, and we can decide if that's the right thing to do.
Okay, I think I want to check this group out myself.
Yeah.
Can you tell me a little bit about maybe one specific I guess note that you bought and had a tremendous success story for a particular investment you did?
Yeah, so well, I've worked on many loans, so I can tell you the one loan that I worked on, that this was purchased in 2020. I purchased it for about $8,400. It's a fairly small investment, right? It's not very large, and it's actually a second lien non-performing note. So the UPB, unpaid principal balance at that time, is about $22,000. So I purchased it for about 38% of the UPB. So that was the price in 2020, as I was talking about. And the loan, after many runs of negotiations, we had to go through something called the settlement conferences. The borrower was kind of interesting. He never wanted to talk to us directly, but he always go to this court mandate conferences.
Mhm.
And every time he goes there and we come up with, we were able to kind of go one step further. Initially we have to collect his financial information, then we come up with the options, then the next meeting he picked the option, then the next meeting we come up with the modification agreement. So in the end, the new loan modification we came up with, believe the down payment was $6,000. The new UPB, the new unpaid principal balance, was about 44,000. Because if you look at the number I gave to you before, the 22,000, that's the unpaid principal balance, right? But it didn't include the amounts that he hasn't paid for years.
Right, and
That
late fees and whatnot.
the interest, the late fees, and all that, it adds up to over 20,000. So after we collect the 6,000 down payment, the UPB becomes about 44,000.
Wow.
So for that loan, we could sell it for about, I would say, at least 33 to 35,000 for that loan. And you can imagine the $8,400 we would be making, 33, 34 plus the 6,000 we've already collected, right? Would be more than triple, quadruple the money. And that's actually not something like we just have a particular great case. That's in the past, actually, that's pretty normal. We get that kind of things all the time. Of course, we will have losses as well. So you do have to average it out. But that's a very normal case, I would say.
Wow.
So, yeah. So in the past, you really don't need to invest a lot of money on a loan, and then you could make quite a bit of money from it. But it takes some doing, and it's not an easy business.
Wow, yeah. 200, 300% return. You're definitely not really getting that investing directly into the real estate. But you said that one was a second lien. Do you have a particular different kind of way that you evaluate that? Because we already talked about the property taxes, and then you got the first mortgage. So obviously the second lien would be even more risky. You might not get anything.
Yeah, so second lien definitely is more risky because, as you said, you could, the first lien could wipe you out. So when we purchase second lien, the important thing is make sure the first lien is current. So the due diligence process is very important. We want to make sure the first lien is current. So that when we purchase the second lien, and when you say it's risky, it's in a way it's risky. On the other hand, the second lien is normally smaller.
Mm-hmm.
So if since the borrower is still paying the first mortgage, that means the borrower doesn't want to leave the house.
Right.
Right. So that gives us assurance that the borrower wants to stay. So because the second mortgage is small, the payment is small, and the borrower wants to stay, they can work a little bit harder and make that payment. Let's say go to Walmart, take on a second job or something, right? To make a $200, $300 to $500 more a month to afford the second mortgage. So yeah, so one thing is in the due diligence process, it's a little bit more complex than the first lien. And the other thing is that we do have a better assurance that the borrower wants to stay. It's not like the first lien, you are the first lien. If the borrower is not paying the first lien, it's very possible the borrower doesn't want to stay or just can't stay, right? So that's a little trick on the second lien world.
Got it. So I'm assuming, do you only invest in notes from properties that are owner occupied, like single family homes?
Yes, so for us, we only invest in primary residency.
Okay. Yeah, that makes it, have people a little bit more skin in the game because they don't want to lose where they live.
Right, right.
Okay.
Because as I said, our goal is not to take the real estate, right? Our goal is to continue to be the lender to collect the payments.
And do you the mortgages that are originated, are you getting a lot of like FHA loans where people, at the beginning they didn't put a lot of down payment into it? And there's less not to say less due diligence, but there's less stringency as far as their credit score, as far as the money they had to put down, all that kind of thing. Does that factor into your decision making?
So we buy all kinds of loans. So whether they are, they were originated as FHA or not, it doesn't bother us, or it's not what we concern. So what we evaluate is, of course, it's the loan, because it could be originally like 10 years ago, 20 years ago. So what we want to see is what's the current property value and whether there's any equity in it.
Right.
Because how much the down payment the borrower paid initially doesn't matter. If the property value has gone up and then there's more equity in the property, then we still like them.
Got it. So you mentioned earlier you don't have a crystal ball, but I'm gonna ask you anyway, kind of what's your prediction, especially, after the pandemic, the real estate market actually boomed, but now I feel like a lot of prices were inflated. So now they're kind of coming back to reality. Then we have this rising interest rate, crazy environment. So how do you think that's going to affect the notes industry? And do you see a lot of more defaults coming in the near future?
Yeah, so currently we don't see that. The inventory is very low, kind of like real estate, especially on the non-performing note side. Reperforming loans, we can still buy, and we still make a lot of purchases. But for the non-performing note, the inventory is very tight, and then the price is very expensive. So it's not a good time to buy. But we do, as I said at the beginning, is we do think that we will see more, but it's just when, right? Whether it's going to be next year or whether it's going to be a few years later. So I keep telling note investors, you need to be patient about it, because we don't know when exactly that will happen.
Gotcha. What's next for you? What's next for the business in the next, year or two?
We definitely continue to grow our fund, our 2 funds. That's what I've been doing, and will continue to do. Our goal is to have our funds to be about 50 million. I don't think we will get there in a couple years, but probably in about 5 years.
Mhm.
That's what we want to get to.
Awesome. Well, you seem like you're well on your way, very well versed. This was a great conversation. I certainly learned a lot of information, especially about the different organizations and groups that are involved with this. So I definitely want to check that out. I can keep asking you a million questions about this, but I want to wrap this up so it's not too long. So I'm going to transition to the last segment of the show, which is called the Fabulous Four. I ask every guest these questions. So I want to go with you. And the first question is, what's your favorite book about real estate?
So I might be a little bit biased. I like Paper Profits. That's by Joshua Andrews, and he's my partner. Because when I start investing in notes, and that's the book, that's one of the first books I've read, and kind of guided me into this business. So I did read another book about, because I do a lot of work with raising capital. So there's another book called Raise Private Capital by Matt Faircloth. And that's if if you plan to raise capital, and that's a good book to read as well.
Awesome suggestions. Second question is, what advice would you give to your younger self just getting started with your real estate career?
I would say start early. Start as early as possible. If you have kids, and then educate them when they are very young, and then take them to property sites and show them. And the other thing is, I think a very important thing for real estate investors is raise capital, and that's something if we can learn when we are very young, I think that would be very helpful as well.
Use other people's money.
Yeah, exactly. Well, because everybody's money is limited, right?
Yeah.
You need to, for us to expand the business, you need to use other people's money. And which does two things: so help you expand your business, also help other people invest and make profit on your hard work as well.
Absolutely. And if you got like a really specialized expertise like this, obviously everyone is not well versed in it as you are. So help other people make money that they couldn't make on their own.
That's right. The other thing I do want to add to is, you asked me about the book. If anybody wanted to learn about note investing and wanted to start reading some books, as I said, you can definitely go to our website, request the Paper Profits book. It's just go to www.paperprofitsfund.com, and then you can request a book. And we send the books to our audience, or as a gift, like when we do webinars.
Okay, awesome. And I'll put a link to the site on the show notes and everything so everyone can, easily check that out. The third question here is, what topic within real estate do you want to learn more about?
I like storage units. So I would say the thing I had some experience with my first project. I mentioned at the beginning of the show. It was rental units, right? We had a lot of rental units. The issue I had with rental units is the tenants. So it kind of, I want to say, burned me out a little bit with that. Storage units, it's that's how I got into note investing, right? It's like I don't need to deal with tenants anymore. Right. Wonderful. But I think storage units also kind of share that kind of because you don't have people live in it.
No
right?
tenants and no toilets, they say.
Right, exactly, right? No leaky roofs.
Right.
Uh,
Yeah, and
yeah.
it kind of has the same, I guess, almost fundamentals when you're looking at it as multifamily.
Right.
You're
Yeah.
getting the economies of scale by having more than one unit, but not
Mm-hmm.
the headache and all the, you know, the, like you said, the tenancy, especially if you have to evict the tenant or anything like
Mm-hmm.
that, you don't have to deal with that at all.
Mm-hmm.
So yeah,
Right.
self-storage is taking off, especially like I know a lot of investors looking at more like tertiary markets. So yeah, that's definitely probably one of the hottest asset classes right now.
Mm-hmm. Yeah.
All right, so lastly, not really a question, but can you give a shout out to another woman in real estate?
Yeah, so I've actually worked with a lot of women in notes and also in real estate. So it seems that like even the first project I was telling you, right, it was four of us together. We worked on that large rental units. Um, I do want to give a shout out to Tanya Miller. She's been a real estate broker for many years. I met her because she was also doing some note brokerage. So we purchased notes from her through her. Um, and the thing about her is she's very persistent. Um, and hardworking, of course, but being persistent yet polite, that just that makes things happen.
Mhm.
Um, and then recently, she and I, she's been helping me with raising some capital as well. So wonderful woman, and I suggest you bring her in too.
Okay, well, you said it. You have to make that introduction. I would love to have her on. Shout
Yeah,
out to Tanya. All
yeah.
right, any last words of wisdom for the listeners?
Well, if any of you are interested in note investing, I suggest you start reading some books. It depends on whether you wanted to invest passively or actively. Either way, I would say start with reading some books. If you plan to go the active route, don't give up your day job yet.
Right. No, that's definitely a word of wisdom before, especially before you master it or have success in it. So how can people get in touch with you directly if they want to learn more?
They can either email me or call me. Do you want me give? I mean, you can put a note out there. Just put my email and phone number there.
Okay, sure
Yeah,
will.
I'm always happy to talk to other people that are interested in in notes and to help them at least get started.
Awesome. Well, yeah, you've been a great resource and wealth of information. I talked to you before, I think it was like a couple of weeks ago, and we had like a 45-minute conversation all about
Yeah,
this. So I just really appreciate your time. I really appreciate you sharing all this info with me and the audience. So look forward to keeping our relationship alive and learning
sure.
more from you. Absolutely. Well, I'm going to sign off here because I can keep going. But this has been a great conversation. I really appreciate it. Jan Wabs, she's with Paper Profits. They're based out of, well, she's located in Southern California, but they invest all over the country. So great resource for note investing. So this has been another great episode of the Pretty Girls Love Real Estate podcast. I'm your host again, Jessica Washington, and we will catch you on the next time. Thank you.
Thank you very much, Jessica.
Thank you.